Hello, I'm Sam Stovall, Chief Investment Strategist of CFRA Research, and I am happy to be here today to talk to you about our outlook for 2021. As we see in the first slide, it gives you an idea of the things I'm going to be touching on today, highlight some of the milestones of 2020, in particular, the fact that the S&P was up by more than 5% only a month and a half into the new year, before being taken over, sideswiped by the COVID virus, and then falling into a 34% bear market, which ended up being the swiftest decline on record, going from peak to trough in only 33 calendar days, which was 3 times as fast as what we experienced in 1987. On August 18th, however, we recouped everything that we lost in that 34% bear market. So the recovery time of 5 months was actually the 3rd fastest on record. So an investor, if they emulated Rip Van Winkle waking up just now, would have looked back over the calendar year and said, wait a minute, the S&P is up more than 14.5%. We had 30 new all-time highs. Gee, this was a pretty good year. But then when he opens his quarterly statement, he probably said, well, wait a minute. We just went through a 34% bear market. We just had twice the number of days in which the S&P was up or down by 1% or more than the average going back to 1950. So we experienced an amazing amount of volatility. Also, my statement, it reads that we were down 20% in price in the first quarter, up the exact same amount in the second quarter. There must have been a bug in the system. And actually, he would be right. That bug was COVID, and that threw the market on its head. And now the question is, what will happen in the year coming up? Well, that's the 2021 expectations. I'm going to share with you our S&P 500 price target for the end of the coming calendar year and which sectors we currently favor. I'll also share with you how we got to that conclusion by looking at historical precedent and our fundamental forecasts. But I'm not a Pollyanna. Well, actually I am. When life gives me lemons, I try to make whiskey sours. But I do acknowledge the fact that we could have some challenging events that could at least delay the advance as we move into the new year. So let's take a look at the next slide. In terms of our fundamental forecasts, we believe that the S&P 500 will close out 2021 at a shade below 4,100. So 4080 to be exact, which is about an 11% price appreciation from the recent close on the S&P 500. We come to that target through a combination of fundamental and technical factors. Each of the stocks in the S&P 500 has a target price for the coming 12 months based on the CFRA equity analyst forecasts for that stock in the coming year. So market cap weighting these target prices and then comparing them with the S&P 500 today, we then add to it what a technical forecast is based on price appreciation potential as a result of the trend that we're experiencing in the S&P so far. And that's how we come up with that near 4,100 target. We also see that earnings are going to go from 137.54 for the S&P 500 to the current estimate of 166.91. Revenues are also going to go from the red into the black, up 8+%. GDP is expected to show an improvement in the coming 12-month period, whereas inflation, interest rates, and the 10-year note are still likely to remain at a fairly attractive level. The exchange rate for the dollar versus a basket of currencies will probably fall an additional 5% in the coming calendar year, and the WWII oil prices will likely continue to stabilize in the period ahead. As we see in the next slide, because of the improvement in the economy, because of the expected growth in corporate profits, and where we are based on seasonal factors, we are emphasizing many of the cyclical sectors, in particular consumer discretionary, industrials, and materials, as well as the healthcare sector because of the virus rollout, vaccine rollout, and the need for more healthcare services in the period ahead. So in the coming period, we do think that the economy will be expanding and investors will continue to focus by looking across the valley into the coming second half of 2021 and what opportunities it might bring. But before we get there, investors like to find out, well, what typically happens based on the 4-year presidential cycle. And as we can see in the next slide, what I did was I looked at the S&P 500's average price change, as well as the Russell 2000 index of small companies going back to the Russell's inception in late 1978. And I highlighted in blue the first year. And as you can see, a 14.3% advance for the S&P 500 and a near 16% climb for small cap stocks are quite encouraging. Not as good, however, as year 3, in which the market anticipates that the party in power wants to remain in power and therefore tries to stimulate the economy ahead of the election. But still a pretty good year as investors are optimistic as to what the new administration is likely to bring. As we see in the next slide, there is still a very big question mark out there. What kind of a government will we have? We already know it's going to be led by a Democratic president, but will it be accompanied by a unified government in that the president and both houses of Congress are from the Democratic slate? Will it be a Democratic president versus a Republican-controlled Congress? Well, we already know that's not the case because the House remained Democrat. But there's still a possibility we end up with a split Congress, a Democratic president with the Republican-controlled Senate. Well, in either case, a unified government with a Democratic president or a split Congress with a Democratic president, we have seen above average price returns for those 26 times since World War II in which the market experienced such a political scenario. Add to that the FOA, or frequency of advance, the batting average. And we see that the best batting average, 77%, was under a unified government led by a Democratic president. And the second best was a tie between Republican president, unified government, and a Democratic president, split Congress. History is a great guide. It's never gospel. So look upon this simply as an idea that in the past, even though we have had a trifecta where the presidency and both houses of Congress have been Democrat, we have still ended up with above average returns as well as above average batting average. Let's take it one step further. So we know the history of the stock market in the presidential cycle, but what about GDP growth expectations? As we see in the next slide, Action Economics has its forecasts for 2020 as well as 2021. Basically, red ink. I should have put all the numbers for 2020 in red to emphasize that global GDP will likely be off more than 4%. The advanced economy is hurting more than the emerging economies. The US down by 3.4%. Euro expected to post the weakest return, and Japan off 6%, whereas China is expected to post the best GDP growth this year as well as next year, but most of the regions expected to see a gain of anywhere from 5 to about 5.8%. So the reason that people say that Main Street is different or disconnected from Wall Street is that Main Street looks at today, whereas Wall Street focuses on tomorrow. Wall Street tends to look across the valley into the coming 6 to 12 month period to say what is likely to happen in that period. And that's how investors price stocks. So as we look to the next slide, we can see what investors think they're seeing across the valley. Well, if the S&P is expected to post a 16% decline in earnings this year, forecast is for a 21% advance next year. And actually, that is weaker than the expectation for a 38.5% rise for developed international countries, as well as the near 36% gain for the emerging markets. So overseas, obviously because they fell more than the US, the potential for growth is even greater, but at least it's not just a one-trick pony, meaning it's not just the US that is recovering it is likely to be the entire globe. So let's dive down a little deeper into the forecasts for the US, looking at style, looking at size, and looking at sectors. And as we see the next slide, this shows the 11 sectors in the S&P 500, what the earnings growth expectations are for 2020, and you can see an awful lot of red ink. S&P down 16.1%, value off 24.2%, small caps down 36.3%, and then if you look at the individual sectors, you find only the defensive areas, in particular of staples, healthcare, and utilities in positive territory, and then one of the growth areas, tech, also expected to do fairly well. But as we head into 2021, it's really those cyclical sectors in general, consumer discretionary, industrials, materials, that are expected to show very strong above average growth rates with their near 58%, 76%, and near 30% growth rates respectively. Also, value is expected to show an increase of almost 24% versus 19% for growth, and small caps are expected to wallop the growth seen for mid caps as well as for large caps. So the rotation that we're starting to see internationally, growth and value, and in the small cap area is something that we think will likely be maintained as we proceed into and through 2021. But what about sort of a confirmation for some of those sectors where we have overweight recommendations, in particular industrials and materials? Well, let's go to the next slide, and I show you two charts that I produce on a proprietary basis, which basically map out the rolling 12-month relative strength for the S&P 500 sectors. So each of the jagged black points on this chart shows you how the industrials or material sectors have done with every 12-month look back, and then we have the 39-week moving average. So it's a 52-week relative strength and a 39-week moving average. And as you can see, on the left, industrials were more than one standard deviation below the mean. Actually, they were more than 2 standard deviations below the mean as of the second quarter of this year. But they subsequently have bounced, are now above their 39-week moving average, and the 39-week moving average is starting to curve higher. So those are optimistic signs. If we look to materials, they too bounced off of their 1 standard deviation below the mean level back in the second quarter, above their 39-week moving average. They're also, the moving average is moving higher, but one additional thing is that the materials relative strength is now back above 100, meaning that the materials are outperforming the S&P 500 over the past 12-month period, and the trend implies, but obviously does not guarantee, that it will likely continue to outperform the market. Now, I mentioned earlier about seasonality. Well, what does seasonality say about sector rotation? Well, let's take a look at the next slide. We've all heard the old saying of sell in May and go away. Well, what that really means is that the weakest 6-month period is traditionally the May through October period for the S&P 500, not only going back to 1945, but in this case, going back to 1990, which is as far back as S&P has sector level data. From May through October, the S&P gained only 2.2% on average, whereas it rose an average of 6.5% during the best 6-month period on average, which was November through April. So 2.2% annualized is a lot better than you would get in cash. So why retreat at all? Why go to cash? You're better off actually rotating. By rotating into the defensive consumer staples and healthcare sectors from May through October, instead of getting the average 2.2% return, you got a 4.6% advance. And in the 6-month period that we are currently in, what I call the cyclical 6, because the cyclical sectors tend to outperform in this 6-month period, while the market was up 6.5%, these 4 sectors on average outperformed the market by 250 basis points or 2.5 percentage points on average. So no guarantee it's going to work again, but because the market feels as if the vaccine will allow the economies to open up again, they are focusing on the future, which currently looks quite bright. But what if we're wrong? What are some of the headwinds that investors will have to face? Well, let's take a look at our final slide. And what we see is we're in the midst of the additional wave of COVID-19, to the point where many cities, many states, even many countries are going back to a lockdown mode. Will that cause international economies or even the US economy to fall into a double dip recession? We don't think so, but that certainly is a possibility. It's a possibility, but not a likelihood or a probability, in our opinion. What about the unresolved election? Should we end up with a congressional gridlock where we get at least one of the two senators in a runoff being from the Republican Party, or do we end up with a blue wave? Will that cause investors to worry that we could see higher taxes on a corporate and on an individual level who might want to look to take some profits now if they can? If we do end up with weaker earnings because of the second wave of COVID, well, then that would imply that the stretched valuations that we are experiencing currently, meaning the S&P is trading at a near 40% premium to its average PE over the last 20 years, indicates not a level of optimism, but a level of overabundance that has to be worked down. So that could be a concern. Lastly, the market has certainly got ahead of itself, in my opinion, in the near term. Take a look at the rolling 12-month price change for the S&P 500 growth minus the S&P 500 value indices. That differential at the end of August was at 35 percentage points, which was the highest on record since the growth and value indices were created back in the mid-1970s. So the implication here that investors need to rotate away from growth and into value in order for the market to be able to right itself, because if not, we could be headed for a sharp decline. Add to that the fact that the Russell 2000, its current price is 32% above its 200-day moving average, which is well above 2 standard deviations from the mean. So we're in a period of excess right now. I believe that the market needs to digest these gains, in a sense, experience a little bit of a pullback before we can move meaningfully into 2001. But once we do, I think that the cyclical sectors will likely lead the way. And like Rip Van Winkle, we can wake up again in 2021's end and say, you know what, this wasn't a bad year either. So with that, thank you very much for listening, and I hope what I have to say will be of value to you.